This is in the course as well. So this is basically the fundamentals of commercial property. And then I want to talk about replacement value on commercial property. So what you've got is, this is the yield curve, and this side is the yield, and this side is the class. Can you guys see that okay? Yep, cool. So for commercial property is valued by the tenant and how much rent they pay, and also who the tenant is. So the class ranges from A class to E class, and not like a Mercedes where E class is better. So in a Mercedes, it goes A, B, C, D, E, and E is the better class. In this one, A is the better class. So A means low yield. So low yield in the current market is about 4%, 4.5% still. And an E-class property is probably 11% at the moment. So there's a big difference, and hopefully that looks like an 11. There's a big difference between a property returning 4.5% and another property returning 11%. And generally it's the same with residential property as well. If you're getting an 11% return on a residential property, you're either doing like short-term letting, or you're doing multiple leases, you're having to extract the value somewhere, or you're buying a property that's in the middle of nowhere and you're getting some huge rental return. Generally speaking, not always. So the definition of an A-class property will be a government tenant in a city location, or a city location where you've got a big population base. So in other words, you've got value in the land itself and also value in the location. So location being close to major city. And you've got a high paying tenant, or a tenant that's got a long lease in place. So the only reason people buy assets at 4.5% yield, commercial assets, is that they park them for 10, 15, 20 years. And they just sit them, and they know every year they're going to get 4.5%, and they know over time that the rent is going to increase, and those rental increases might be in line with CPI, or they might be 3% increases. So they know that they're going to get at least that return. And then over time, as the rent increases, hopefully their yield stays the same, which means the value goes up over time. So that is an A-class property. And that's why people buy A-class properties. They're okay with a 4.5% yield because it's safe and it's better than sitting it in the bank. Although at the moment, it's pretty close. So the only advantage to buying a commercial property now at 4.5% is the potential for capital growth in the years to come, not immediately, like immediately leaving yourself in the bank. So 11% E-class. I've seen some 11% yielding properties. I had some sent to me, and I thought, wow, that's fantastic. 11% sounds really good. But when I looked at them, they were hotels in the middle of nowhere, with a population of like 10,000 people. And people were buying these hotels or motels or whatever you call them. And yeah, they were about 11%. So on the surface, the yield looks really good. So 11%, just to round it off, if you're buying $1 million asset, it's generating $100,000 a year in revenue, or a little bit more. 11, that's at 10%, but 11%. But that is an E-class property. So it's old. Some of them were being sold as vacant possession. So it either has a really crappy tenant, or it doesn't have a tenant, or it's in the middle of nowhere. It's not near a major capital city. So the likelihood to resell that, if you need to resell it or to get another tenant, is low. So there's a very big risk difference between buying a low yielding property, commercial property, and a high yielding one. And you got to make the same assessment with residential as well. If you're doing the buy and hold, what's better off for you, the capital growth or the cash flow. Now you do need both. So unless you're like an institutional investor or somebody that's sitting on a lot of cash, you probably don't want to be buying 4.5% yielding commercial assets, in my opinion. But you also don't want to be buying 11% yielding assets unless you're getting some sort of arbitration. So there was a property I could have purchased a little while ago. I got gazumped. The agent did the dirty on me. It was a commercial property. This is probably 10 years ago. And I'm kicking myself I didn't jump on it. Earlier it was $150,000 and the property was returning, it's like 50, no, it wasn't 50,000 a year, sorry, it's 25,000 a year as net. I think that's what it was. And the property was half vacant and it was heritage listed. So super cheap commercial property. It was in like, it was like a 4-hour drive from Brisbane. So it was definitely an E-class property, but it had such a high rental yield. It was like 25,000 a year. And half of it was vacant. So all I needed was one more tenant paying whatever, an extra 20,000 a year. And I would have paid this asset off in like probably 4 years, which is probably what the owner did. So I missed out on this property by like 10,000. The agent did the dirty on me. Literally after I'd signed the contract with the price on it, I was waiting on a signed contract back. He didn't call me back for like a week. And then I tried to call him and basically I found out he'd sold it to somebody else for like 5 grand more or 10 grand more. So and then you've got everything in between. You've got B, C, D, and so forth. So with commercial properties, the people I've seen that make really good money is when they buy in here at like an 8% yield. And this is what's happened over the last 10 years. They buy in at an 8% yield where the class of property isn't a C class. They actually buy like, say, a B class property. They've bought it at 8%. And then the market has meant that it's come back to like 5% or 6%. So what that means is it's only a small move in yields, but as a ratio, as a portion, it's huge. So if you go from 8% to 5%, so let's just work out just roughly. So let's just say the property is making 100 grand a year. So at an 8% yield, let's get a calculator out. Property is valued at 1.25 million. So it's 100,000 divided by 8%. So let's just say somebody bought a property at 1.25 million, 8% yield. And then the market drops to 5% because that's what it did when interest rates came back. So if that property is 5%, so that now at 5%, that's worth 2 million. So that's where a lot of this capital growth has come from, but that's only based on the rent at the time. So that's only based on $100,000 rent, but over time, what happens is that rent increases with CPI. So if you've got, let's just say you have 5 years worth of rent increases on 100,000 at 3%. So you got 100,000 times 1.03, and you got to do that for 3 years. Oh, sorry, 5 years. I should use the advanced calculator. So that equals, so if you have 5 years of rent increase, I'll just put it over here. So 100,000 times 1.03 to the power of 5. For those that did maths, so all the power of 5 means that you multiply it by 1.03, so that's 3%. So you times it by 103% for 5 years. That gives you 115,000 in rent. Let's do 115K. So if you bought an asset at 8%, 5 years later, it's now 5%. The value of the property goes up. So if you do 115, 1.05, so your property is actually, after 5 years, is actually worth 2.3 million. So it's basically doubled in that time, and then you've collected the rent along the way. So with commercial property, and especially if you're doing development and you're manufacturing your own equity within commercial property, you can pay them down, have commercial properties paid down, even these types of commercial, in like under 10 years, just from the cash flow that it generates, as well as the capital growth. So that's how commercial works, high level. And that's why a lot of people have made a lot of money in commercial, because 10 years ago you could buy in, or 5 years ago, you could buy in for sort of like 7-8%. And then, they've dropped to 5%. So with commercial, if you're buying in now, there's going to be commercial that comes up that's very lucrative. I'm starting to see it. So the commercial window and the commercial market is very different to resi. So commercial market is Australia-wide. Generally speaking, there's different subsections of the commercial, but generally it's Australia-wide because it's based on cap rate. And a lot of the commercial products are based on what people can get in the bank versus what they can get from a property asset. So it's really based around interest rates, but also bond yields as well. A lot of the bigger investors in commercial property will look to do bond yields instead, because that's sort of the risk appetite a lot of these guys are looking for, especially at the A class of property. So depending on what bond yields look like, you know, they might be looking at a 5-year bond or a 10-year, whatever that is. Whatever they look like, you know, that normally is where commercial property heads in terms of valuations. So we normally run through a 15-year cycle with commercial. So the last cycle was around 2008. And now we're, 2023. So we're kind of at the end of that cycle. So now we're into kind of the bust phase, which I think commercial is fraught with danger in a way, but I also think interest rates will start to come down probably mid next year. So I think there'll be a bit of pain in the commercial world. There'll be a bit of a wash up into next year. And then I think commercial cap rates will start coming back down. So I think there's really good buying opportunities in the next 12 to 18 months for commercial. I say that about resi too, but yeah, commercial buying opportunities where if you can get something at 7-8%, and in 4 years time, 5 years time, that drops to 5%. I think it'll happen again. I think it has to. Maybe it won't drop by that much, but I think it will drop as interest rates start to come down and bond yields compress. So just one thing with commercial, as I spoke about, this A class, E class, and if you can understand that concept just in a nutshell, you may not understand all the intricacies, but if you can understand that overall concept, you'll be better than most people that even invest in commercial, because I feel like people just look at commercial for the yield, especially lower assets. So there's a lot of competition at that, sub 1 million mark. The other big consideration is the deposit you got to put in. So you normally have to put in 30% deposit, which is 70% LVR. So that's like maximum LVR. A lot of the LVRs are even lower than 70%. So you got to chip in more money into these things. And the other difference is that you can be margin called on commercial loans, so they can revalue your property, which is again why commercial can sell so cheap. And I think why it will, because if these properties now that were 5%, and we've had some properties that have gone from 5% to 6%, it doesn't sound like a lot, but that's a 20% decrease in valuation. So 5% to 6% is 20% decrease in valuation. So if you had $1 million or $1.2 million property, now it's worth 1 million if your cap rate goes up by 1%. And this is literally what's happened with shopping centers. They've gone from 5% to 6%, and some of them even more. So a lot of shopping centers, I got a question about a shopping center, which Rick, if you're on, you're not. Rick asked me about shopping centers. If I was developing a shopping center right now, a lot of them don't work. So a lot of shopping centers, you can't develop and make money on them. So buying a shopping center in the current market is better, like an existing one, versus trying to develop one. It's way better to buy an existing one because of that cap rate shift. So that replacement value, so sort of the same theory with units. So if you know your costs, to develop are this much, whatever that number is. So if your costs to develop are here, in a normal scenario, you want your value to be here, and that's your 20% profit. So, and that goes with resi. So commercial development is the same as residential. It's only that the value changes, and the value changes based on the tenant. So that's really the only the only extra thing you need to know, which doesn't sound like much, but there are a lot of intricacies to it. So this is in a normal situation. You work out your costs are going to be this much, and the end value is going to be 20% more. And life's good, you make this 20%. Now I've just shown you if the cap rate goes from 5% to 6%, which is only 1%, doesn't sound like much. And it's pretty good considering the interest rate's gone up by 4%. This has only moved by 1%. If that moved by 1%, that literally erodes all of your margin. So your 20% margin just goes, and this is literally what's happening to shopping centers. So the 20% margin that they were making, or 30%, whatever it was, is now reduced to 10. So I've looked at a couple of shopping center sites recently, and I haven't been able to make them work because the cost to build are so high, and the end value has dropped. So the end value has dropped by 20%, but the cost to construct has increased by 40 to 50%. So you've kind of got a double whammy. So what you want to be looking to do, and this is happening in the market right now with commercial, is if you're buying an existing commercial, you want to be buying below replacement value. So if your replacement value is here, and I'll give you an example of someone I know that bought an exceptional commercial property. So you want to be buying below this cost. And the only way to know the cost is you know how to develop the property and what it actually costs to develop it. So if you don't know that, then you don't know really if you're buying below cost. You can probably take a guess and say, oh, that's how much that thing would cost to build. But then you've got to factor in all the other items as well. So I'll give you some numbers to give you how lucrative this can be. I'm going to rub off this graph. I'm just going to repeat this graph here. So your costs are this much. So I'll give you an actual example. So this property replacement value was about, I reckon it's probably more, but probably 20 million. So somebody I know that bought this property. And if I had known about it, I would have bought it. So the replacement value on this thing was 20 million. It was a hotel. I think it was 84 rooms, and it was rented to Ridges. However you spell Ridges, something like that. Oh, it's RD, Rid. Anyway, it was rented to Ridges. So Ridges had it. They actually owned it. Ridges, whatever the company is, and they were selling it as a vacant possession. So not only was it, I'll tell you the best part. So it's 84 room hotel. It was in a sub-regional, 20, 30,000 people. So it was not in the middle of Australia. It was the East Coast. And the replacement value was 20 million. Anyone guess how much they bought it for? Just a stab in the dark. This is the deal. This is the best deal I've seen in my life thus far. 10 million. So Faye guessed it. Okay, so that'd be a pretty good deal. Remember, it's an older building, so replacement value isn't, replacement with a brand new one. So it wasn't brand new. It's probably maybe 30 years old. So if you bought it for 10 million, you'd think you'd be doing pretty well. So the previous purchaser, I think they paid 15 million for it like 10 years prior. Actually, probably longer, which is Ridges, because they owned it. I think Ridges paid like 15 million for it. So you think 10 million would be a good deal? No one else wants to have a guess? No one. What about if I said the person that guesses the closest wins all the jelly beans in the jar? 5? Yeah, okay, maybe. Okay, so I don't have enough room on here. They actually bought it for 2 million, but 16. So they bought a $20 million asset replacement value for 2 million bucks, but it gets better than this. So what I didn't tell you was it's 84 rooms, but it also had 6 commercial tenancies. And they were all on separate titles. You guessed 2. Well, actually, you didn't quite get it right, because I'll tell you the kicker. So they bought it without Ridges in place, because Ridges were going to leave. So they basically bought a vacant hotel in the middle of this sub-regional town, and it was on like 6 or 7 titles, and it had 6 commercial, and they were all vacant. So they're buying a vacant building, so that's why Ridges sold it so cheap. It's a vacant building, no tenant in place, so the value with commercial gets attributed to the tenant. So they were planning on leaving. So what ended up happening is they put it on a contract for 2 mil. I think it settled in 6 months. Over the course of the 6 months, Ridges actually said, hey, can we stay on? So Ridges signed like a 10-year lease. So Ridges said, hey, we actually don't want to leave. I think it's RDY. Anyway, Ridges said, hey, we actually don't want to leave. We changed our mind. We want to stay. So of course, you're buying it for 2 million. You're like, sweet, yep, you can stay on, because automatically the value with Ridges goes from 2 million to probably 10 to 15, depending on what lease they're paying. I don't know what they're paying. But then it gets better than this. Yeah. So they're buying it for 2 million, and a week before settlement, he told me, or I think it was a week, or it was close to settlement, Ridges actually left 1 million in the sinking fund that they forgot about. And the sinking fund belongs to the building, and the building has a contract for 2 million. So on settlement, they were buying a property worth 20, they were buying it for 2, and then they got $1 million in the sinking fund. So they bought a $20 million asset for 1 million, and they got Ridges as the tenant with 6 other commercial properties. So if anyone wants to look it up, it was the Ridges in Gladstone that sold, and that sold, it's probably 4 years ago now, maybe 5 years, 4 or 5 years ago, to a guy from Melbourne. So yeah, that was the deal, the best deal I've ever seen in my life. Might see another deal like that similar. Look, I know about some other commercial properties that was well undersold. And it's a lot of the time it's financial institutions, because it's not their money, they don't care. My mentor bought a property for 5 million. Again, it was a commercial property. The fund that he bought it off had previously paid like, I can't even remember what the number was, 50 million maybe. I think it might have been similar, like 10, he bought it like 10%. And the fund that he bought it off, they just wrote it off. So keep in mind, guys, especially for financial institutions, this is our superannuation money that a lot of these companies are playing with. So they'll buy whatever it is, a $50 million asset, the market turns and they need to liquidate the cash, and they'll go and sell it at a loss. So all those losses you saw in your super in the GFC, if you had commercial real estate, and I know the share market took a big tank as well, took a dive, but if you had any allocation in commercial real estate, it would have been exactly like this, where you had a financial institution pay 15 or 20 million and then just sell this thing off, and they don't care because it's not their money, and they're not liable to anyone. Like the fund won't perform very well, and they won't look great, but none of the funds performed well after the GFC. So anyway, this gives you an idea. Commercial can be very lucrative. You don't have to do the development. If you understand even just the basic replacement costs, even of the basic building costs, that is an exceptional deal. If that comes up in your lifetime, you should jump on it. But yeah, that was when I found out